Bloomberg Audio Studios.
Podcasts, radio, news.
Hello and welcome to the Money Stuff Podcast, your weekly podcast where we talk about stuff related to money. I'm Matt Levine and I write the Money Stuff column for Bloomberg Opinion.
And I'm Katie Greifeld, a reporter for Bloomberg News and an anchor for Bloomberg Television.
Katie, what are we talking about today?
We're going to talk about DirecTV, buying Dish. We're going to talk about FanDuel and gambling addiction. And we're also going to talk about Apollo. Hey, Matt, have you ever gotten a really bad haircut?
I've almost exclusively gotten really bad haircuts. I feel like I recently
cut that out.
I've recently moved on to getting better haircuts, but for much of my life, I got bad haircuts.
Your last few haircuts, I've said you got a haircut. Well, it looks nice.
Thank you. That's the highest compliment.
It's really easy to tell with men because you have shorter hair. Anyway, moving swiftly along. So DirecTV paying $1 for Dish and $9.75 billion of debt.
Or less than that.
Yeah. Well, go on. Tell us why.
They're buying Dish for a slightly negative or meaningfully negative amount of money. Or they're trying to.
They are trying to.
They're trying to. So Dish is a company, sort of. It is an entity, but it is owned by EchoStar, Charlie Ergen's satellite conglomerate. And so EchoStar wants to sell it to DirecTV. DirecTV wants to buy it. But the value of the company is apparently somewhat less than its debt. So it has like $9.75 billion of bonds outstanding. Mm-hmm. And DirecTV doesn't want to pay all those bonds back, so it wants to buy it for $1, a check for $1 to EchoStar, and also for taking on the debt, but taking on less than all of the debt. And basically, to get the deal done, the bondholders have to agree to a bad haircut, an unpleasant haircut.
Yeah. So we're talking about $1.6 billion worth of haircutting going on.
Yeah. So bondholders have to agree. Like they can just insist on getting their money back. But if they agree to take $1.6 billion less, so like a total of like $8.2 billion, then the deal will go through. And if they say no, then technically the deal doesn't have to go through. But like everyone understands that this is just the opening of negotiations. And so what is happening is that the bondholders have said no. And the way it works is you kind of get a vote. So, basically you need to get like 2/3 of each series of bonds to agree. And so some bondholders have said that they have accumulated a blocking position, which means basically they have enough bonds to prevent the deal from going through. And they don't not want the deal to go through. This will be a better company that is more likely to pay off its debts if it gets more money in. And what they want is just to get less of a haircut, right? There's different series of bonds with different maturities that were trading at different market prices. And like the longest dated was trading in like the 50 cents on the dollar area. And they offered to pay it off at 60 cents on the dollar. And the bondholders would like more than 60 cents on the dollar. So that's sort of the state of play is they've said no, but it's like an opening of negotiations.
Mm-hmm. They would like a slightly less worse haircut, something that doesn't look as bad.
I'm resisting the temptation to just spend the whole time talking about my own history of quests for getting haircuts.
I cut hair.
Do you?
Yeah, I cut men's hair.
Okay.
Oh,
that's right. I did know that, actually.
Yeah, I cut my husband's
hair
during the pandemic.
I feel like I've seen your Instagram of you cutting your husband's hair. Yeah.
My dad, my brother, and my nephew. My nephew's gotten like 3 haircuts in his life, and I've done all of them. This
is going to be like the Money Stuff live event.
Yeah.
Will be.
I love cutting hair. Okay. I'm always looking for opportunities. Anyway, Bloomberg News, that of course is according to Bloomberg reporting about that blocking position. Bloomberg also expanded on that in the Brink newsletter, going through the various contentions that this group of creditors have. First, they contend that they are being asked to take losses as high as 40% of face value. That obviously doesn't sound great. While EchoStar owner Charlie Ergen comes out relatively unscathed in all of this.
Yeah. I don't know the full history of it, but like obviously, they're selling it for $0 of equity value, right? So like it's respecting seniority in the sense that the equity is getting nothing and like there's apparently so little value here that in addition to the equity getting nothing, the bondholders have to take a haircut in order to sort of sell the asset, right? Mm-hmm. And the fact that the bonds are trading at, 50-something cents on the dollar is just that, people did not think there was a ton of equity value here before this deal was announced. So this is a deal where you look at like the trading prices of the bonds and you're like, oh, if we can get this asset for the valuation implied by these trading prices and also paying $1 to the equity, then it's a good deal, right? And then you're like, oh, we'll pay a little premium to the values implied by the trading prices. And like that's like normal M&A, except that here, the thing is underwater. And so instead of paying off the shareholders, you're paying off the bondholders. But you're not paying them that much of a premium to the trading prices. And unlike shareholders, they have a contractual right to demand their money back. So it's a fight.
Well, to that point, one of the other contentions is that some of them argue, and I'm reading directly from the Brink newsletter, some of them argue that the sale of DirecTV for $1 confirms that the company was already insolvent when it completed a contentious deal in January to strip them of their collateral. If the company was insolvent at the time, that transaction could be voided and the whole plan could be called off.
Yes. But you have like your legal rights, but you also have like, if you win those arguments, like what, the company goes into bankruptcy?
We won.
Like, yeah, there is going to be some intercreditor fighting about like, who gets the collateral or whatever. But like, I think in general, you would rather have the company be solvent and get paid a premium to the market value of the bonds than have the company not be solvent and sort of take your chances. But you want to get paid a premium to the market value of the bonds, and like this premium was a little slim.
It's interesting that this might be what kills the deal, because I remember when this was
announced, this is the whole deal.
I know, but people were talking about regulatory concerns, blah, blah, blah. Was it going to get blocked? Because you remember the history of these two companies, DirecTV and Dish. They've been flirting with merging for like 2 decades, and that regulators sued in 2002 to block a previous attempt to combine. Now they're coming back together. It's sort of like J-Lo and Ben Affleck. And we know how that ended. They recently filed for divorce.
I do not.
Yeah.
I followed that closely.
Yeah.
I don't know. The world has changed since 2002. And
That's so true.
The idea that Dish and DirecTV are monopolists in the provision of television is a lot less compelling than it was 20 years ago, right? I mean, who has Dish or DirecTV? Like it's just, streaming has overtaken them. And so it is now like these two somewhat troubled players are trying to merge.
Well, that's the thing. Like, what are we fighting over? There's some great Bloomberg intelligence data that shows that together, Dish and DirecTV have lost 63% of their satellite customers since 2016. That's according to the companies. And then Bloomberg Intelligence says that nearly 30% of that loss of their user base, or 6 million subscribers, has been since the start of 2022. So, I mean, it's ugly. Like, this is a tough business. Right. And you're right. Things have obviously changed dramatically in the past 22 years.
Right. It's a tough business.
And I mean,
it's trading for lower than the value of the debt. There's maybe something to be done.
Yeah.
The other thing that's interesting is like, we say like DirecTV is buying Dish, but like kind of what's happening here is TPG is buying both of them, right? Like DirecTV is like a AT&T subsidiary that like AT&T saw the writing on the wall and sold the part of it to TPG, the private equity firm. And now as part of this deal, TPG is buying the rest of it and also putting in cash directly to finance Dish like before the deal closes and also buying Dish, right? So this is like going from being a big part of two public companies to being, a private equity roll-up that, it sort of sounds like the classic private equity playbook of like a declining business and like, sort of extracting as much money as they can for as long as they can.
Mm. Well, I was kind of wondering about the creditor dynamics here, and you wrote a bit about this. I was wondering if this is like a beautiful moment of like the creditors banding together to stop themselves from being screwed. But it seems like you're saying that things will get ugly between creditors.
No, they're banding together. It's nice. It is nice. But like you can't just be like, oh, we want 100 cents on the dollar because like there's some risk there, right? The other thing that I wrote is that Charlie Ergen clearly has some ability to put on past creditors, but it is interesting to me that this is a private equity roll-up. What I wrote was that you could have a model that is like an important skill set of private equity is extracting value from creditors, right? Like they're repeat players at doing liability management transactions. And if you get good at that, then like you can make a troubled company worth more than anyone else could because you can, make the creditors take back less money. And, if you own a troubled company, you might be like, well, I got to sell this to private equity because they're the only people who can kind of extract some value from it. Although here, the equity owner got $1. So it's not that much value for him.
Watch this space. Unless you have anything else to say.
I like that you end every segment with watch this space.
Watch this space. Let's talk about FanDuel and gambling addiction. I really enjoyed listening to this or
From
reading
the
it.
robot.
From the robot told me all about this.
So there's this guy, Amit Patel. He worked for the Jacksonville Jaguars, which is a football team.
Yeah.
You might know.
I heard of him.
And he stole $22 million from the Jaguars to do a bunch of things. He was arrested, indicted. He's in prison right now. He pleaded guilty. He did a bunch of things with the $22 million. And the prosecutors, of course, listed them all. He bought some fancy watches. He paid for trips on private jets with his friends.
Normal stuff.
He put some of the money towards a retainer with a criminal defense lawyer, which is an amazing thing to do with money that you've stolen, right? It's I know I'm going to get caught. I'm going to hire my criminal defense lawyer in advance so that when I get caught, at least I'll have a well-paid criminal defense lawyer.
Yeah.
Just amazing, real indication of his state of mind. He was not oh, great, I'm committing the perfect crime. He was oh my God, I am stealing all this money and I'm going to prison.
Borrowed time here.
So why did he steal all this money even though he knew it was a bad idea? Because he was a gambling addict. Because most of the money that he stole went not to his lawyers or to watches, but to FanDuel. I read an article saying that he was known as the biggest loser ever on FanDuel. He lost the most money. And so that was bad and he went to prison. And this week the news is that he is suing FanDuel for letting him do that. And I have a lot of sympathy to him. I have no way of handicapping how this lawsuit will go. I think there's a real common reaction of come on, man, you stole this money, you voluntarily bet it on FanDuel, and now you're suing FanDuel for letting you. But I kind of think he's got a point.
What is he suing for? Does he want his stolen money back?
He wants money. Does he want his stolen money back? He wants money for fraud damages and his emotional distress. He's suing for more than the $22 million.
Yeah.
I think the number in the lawsuit is $250 million.
Yeah, it's meaningful.
But he's not going to get I think he'd be happy with some money. But yeah, I mean, there's a bunch of theories, but basically they're you exploited my gambling addiction. And even though you had policies to not take money from addicted gamblers, you went around those policies. So there's things he had a VIP host, right?
That was the craziest part to me. The VIP host that he was texting with.
Oh, yeah.
100 texts a day?
Yeah. It's like any casino business, right? If you are a whale, if you're gambling a lot of money, they will do nice things for you. He got tickets to sporting events and things, but they also have a customer service representative whose job is to make you feel special so that you gamble more with them.
It's just so many texts. Even the height of my texting days in high school, I don't think I was exchanging that many text messages.
Well, I think that a lot of his texts were
gambling orders.
Please give me more credit on FanDuel so I can bet more.
It's just so much.
Yeah. But also the texts were they moved it from the guy's work account to his personal phone for the reasons that, I talk about a lot when the SEC goes after, it's easier to avoid compliance when you're texting from your personal phone. And they were doing dummy texts, they were making sure to text from the guy's work account a few times a day so that compliance wasn't why did you stop texting with this guy? Because if compliance saw that, they would know he was texting somewhere else. But anyway, so he had this VIP host, and the VIP host was getting around all of, first of all, he was doing it from his personal phone, but secondly, he was allegedly getting around limitations on how much credit the guy could get. And there's other claims he was doing a lot of gambling with just his Jaguars corporate credit card. And FanDuel is sort of regulated like a financial institution. It has anti-money laundering requirements.
Right, for sure.
And those requirements, they're sort of geared towards you should not be taking stolen money. And because he was gambling with stolen money, he is now arguing you should have known, and you probably did know, that I was gambling with stolen money because I was, for instance, using my corporate card to make bets. And you should have stopped me, and I should get the money back because you didn't do the anti-money laundering and know your customer checks. Which I think is a really interesting theory that traditionally when a bank fails to do its money laundering checks, it will get in trouble with the government if it allows a terrorist or a drug trafficker to use its payment systems. You never hear about the drug trafficker saying, well, you should have to give me the money back because you didn't do your KYC checks. But here it's I was doing crimes and you didn't check, so I should get the money back. I don't know. It's a good theory.
Okay, so he stole the money from the Jaguars, but he was using his Jaguars corporate card?
That was the theft. He would just place...
bet on sports?
He would place bets with his corporate card.
I feel like that in and of itself should be a no-no.
Yeah, that's what he's saying.
No, I know, but the fact that it's a sports organization You know, like it's a sports team.
Oh, right. Separately from it being stolen. Yes,
Yeah.
I agree with that too.
Like they weren't like, oh my God, why are we getting millions of dollars from
a sports
football
team?
team?
Yeah, you're right.
Like,
that's also bad.
That's bananas.
I agree with you.
Yeah.
Yes.
I do wonder, so as you write about, of course, this is good business for FanDuel.
I mean, the biggest ever loser on FanDuel is, it's like $20 million to FanDuel.
But like how many of him are there, I'm wondering. I wonder how many cases like this man there are. Maybe to a lesser extent, but
I think it's a really dicey business, right?
Yeah.
Because like there are clearly people who are billionaires who like a gamble who will lose $1 million in a week and be like, it was fun and it's fine. And like those are the best customers, right? Like those are the customers who can lose a lot of money and not feel it are great. But there's not that many of them, right?
Mm-hmm.
Then there are the customers who lose a lot of money and can't really afford to lose a lot of money. And like, all these sports books have policies about safe gambling and, they're in a regulated business and they don't want to look like they are exploiting addicted gamblers. But clearly they make money by people losing money. And the more money people lose, the more money they make. And not all of those people can afford to lose the money that they lose. And I've written about, there's a subset of sports gamblers who are advantage gamblers who win, right?
Yeah.
Who can identify exploitable bets and make money at the expense of sports books. And those people, their problem is that sports books don't like them and won't let them bet very much. And so a lot of the business of being a professional sports gambler is not knowing who will win, but it's knowing how to bet a lot of money at a sports book. And there are stories about how people do it. And one thing they do is they try to look like addicted gamblers because that's what the sportsbook wants.
Yeah.
So there's a story of like a guy who has a bot log into his sportsbook account every night between 2 and 4 a.m. because that just looks desperate.
Yeah.
Right? So if you look desperate, they're like, oh, this guy's an addict, so we'll give him more credit. And like he seems to think that works, right? So there's like this real tension where these companies really do not want to look like they're exploiting addicted gamblers, but like that is where the money is.
Reading this and thinking about it kind of made me think about, the conversations around Robinhood when the meme stock era was really in full swing.
It's
of course,
the same
like
story.
Yeah, like what is the responsibility of like Robinhood to make sure people aren't trading more than they can afford to lose? And there, of course, are tragic stories about that.
Yeah, and Robinhood will tell you that they are, and I think there's a lot of truth to this, that they are sort of a gateway drug to sensible 401k investing, right? Like you come to Robinhood because it's fun, and then like it stops being that fun, and you're like, I'll just put it in like an S&P index fund.
You like graduate up.
You just like get bored of like day trading GameStop, and you put money into an S&P fund. That seems plausible to me.
Like you're like, why does this stock SPX keep beating me?
Right. So like, I think there's some plausibility to that. At the same time, like you look at how Robinhood makes money. They make a lot of money on options, right?
Yeah.
Like a lot of money on options, right? It's hard to argue that like a lot of retail traders are responsibly saving for retirement by day trading options, but that's where the money is for these firms. I will say, I wrote about like there's a move to make more single stock daily expiry options, which I don't want to say is a pure gambling product because I think you could imagine a hedging use for it for somebody, but it's like it's
pretty close.
It's pretty much a gambling product.
Yeah.
And the articles I read about it, there's a lot of push from some like market makers to do that because like it's like a gusher of money.
Oh yeah.
But Robinhood has pushed back on it because if single stock 0-day expiry options become a big thing, Robinhood will offer them, and Robinhood's customers will use them. And there will be terrible stories.
Yeah.
And like Robinhood doesn't want that headache, right? They're like, we would make a lot of money doing this, but we don't want that. That looks like catering to gamblers. And they don't want it,
Yeah. Well, it would give us something to talk about on the Money Stuff podcast.
0-day single stock options.
Yeah, if it goes
we
through.
just talked about them.
I know.
There it is.
We can build upon this.
It's a gambling product. It's like they expire at 4. And so like if you're hedging earnings and earnings come at 4:15, you're like exercising at a stale price. It's crazy product.
I'm really glad that that's a sandbox I can't play in because that sounds fun.
What, 0-day
Yeah.
single stock options?
If I wasn't
Like
here, I would be the most degenerate day trader. I would have a great time.
Really?
Yeah.
I didn't know this about you.
I love adrenaline. You can't tell?
Okay, but like that particular form of I would not be a day trader. I find it scary.
Well, there's
Watch
two
this
sides.
space.
There's two sides to a trade or something. Let's talk about Apollo. A lot of Apollo headlines recently.
Yeah, they did
Apollo
an
making a
investor
lot of
day.
moves,
They're like doing some stuff. Tell me about it.
Well, I was going to turn it over to you. So Apollo's Investor Day, they came out with a big projection, $10 billion of annual earnings in 5 years. Before that, they joined forces with Citigroup for this $25 billion private credit push. It just feels like Apollo has been particularly in the news lately.
Their investor day, they sort of position themselves as everyone's retirement fund.
Yep, they certainly did. CEO Mark Rowan, he said that privates can produce 50 to 60% better outcomes for 401ks. And you would expect him to say that. I don't know.
That's it.
Well, of course. I mean, that's the thing. Like, of course he would say that. Do we need privates in 401ks? I don't know.
I don't know. I was thinking about this. Katie, you are ETF build. You're a big believer in ETF.
You can't even get an ETF in a 401k.
You're a big believer in daily liquidity.
Sure am. I'm sorry, I just value transparency and intraday liquidity.
But it is possible. Like a 401k is really a perfect place to not have those things. Like it is.
Yeah, I know.
No, like it is and it isn't, right? Because like you because it's for small investors, you do want like transparency and low fees and not like, you don't want people to like lock their money away for 30 years and forget about it and have someone stealing it, you know?
Yeah, no, definitely.
But it is a place where you can lock your money away for 30 years. And that does suggest that you don't need daily liquidity, right?
Yeah.
And if it is the case that illiquid things pay a premium, and like, you know, Apollo sort of looks around and is like, we are in the business of investing in illiquid things, right? And so who do we find on the other side? Like who will give us the money to invest in illiquid things? It's like, well, you know, it's pensions and endowments and like, oh, let's have a, you know, Athene is like, I always thought of Athene as sort of like a life insurance company, but it's not really. It's like an annuities company, right? It's like or like those are kind of two sides of the same thing. But like it's, you know, they position it in the investor day as a retirement services company, which is what it is, right? And so eventually you sort of get to the point of saying, you know, we need all the money. And the place where people have long time horizons and so some ability to take illiquidity is like in their retirement accounts.
Yeah.
It makes a lot of sense to me. When I think of it that way, it's like a little weird that retail products and like mutual funds have liquidity requirements because it's not exactly addressing the problem of retirement savings, which is why people have annuities and stuff, right? I mean, that's like the classic way to do this is like Athene sells people an annuity and then Apollo is in charge of figuring out how to invest their money for the next 40 years or whatever.
Yeah. No, I hear what you're saying. And it does make sense. Like, again, you're locking away your money for 30 years. You don't need that intraday liquidity. I guess it's just what I like about public markets and public assets is just knowing the performance.
So Cliff Asness has this great blog post from a couple of years ago. Cliff Asness is like a public markets value investor, right? One thing he doesn't like is that private equity, which is kind of like, you know, value investing in companies, private equity has what appears to be a much better Sharpe ratio because it like has much better risk adjusted performance because it has high performance or, you know, has sort of vaguely S&P like performance, but it has much less volatility. And the reason it has much less volatility is because it doesn't report market prices every day, right? Like a lot of what happens in the public market is prices go up and down without that much change in fundamental value. And so it looks like your stocks are very volatile. Private equity doesn't look volatile because they report marks once a year or whatever. And like they have, you know, they have some flexibility to say, oh, nothing's changed. And he is like kind of mad about that. But he's also saying, he says in this piece, you can see why that's actually good. Because like what happens is if your stocks move around every day, you'll be tempted to sell them at the worst time. You'll panic, right? Buying private equity is a way to like discipline yourself and prevent yourself from panicking when market prices move around. And that story about private equity is traditionally a story about pensions and endowments, right? Who, you know, are maybe prey to like political factors and will take their money out if prices go down and can stop that by investing in things that don't report prices. But it's like also equally true of retirement savers, right?
Yeah.
Like if you're looking at your 401k every day and saying, oh no, stocks went down and you take my money out, like maybe it's better to be locked up in something that doesn't have price transparency.
That's a fair point. I do find it fun that, of course, Apollo is publicly traded.
Yes.
And it's interesting to consider its market cap. It's something like $74 billion. Their AUM is like $662 billion, somewhere around there. It's a fun thought exercise to compare that to BlackRock, which has $10 trillion in AUM, and their market cap is like $140 billion. And this is something that we've talked about a little bit before. Like
Pershing Square.
Yeah, exactly. Like how the stock market values these different asset managers.
I think it is pretty straightforward, right? Crudely, if you put a 10 times multiple on earnings, right? Like Apollo can kind of extract kind of 1% in fees.
I have some numbers right here, actually.
Oh, yeah.
I printed it
You're
out.
showing me these
I hope
numbers.
I'm reading this right. So if you take a look at Apollo's AUM, the cents earned per $1 of AUM is 0.89 cents.
Yeah, so close to 1%.
Yeah. And then you compare that to BlackRock, and it's like 0.06 cents.
Well, like 6 basis points. I think like there's two kinds of asset managers. There's like expensive asset managers who charge 1%, and there's cheap asset managers who charge like 1 basis point, right?
Right.
And then you put a 10 times multiple on them, and like BlackRock should trade at like 1% of AUM, and Apollo should trade at 10% of AUM, right?
Yeah.
Because like they're charging 1% of AUM versus charging 10 basis points of AUM. And I wrote about this in the context of Pershing Square, where they raised money at a valuation for the management company of something like 50% of AUM, which implies quite insane things about the fees they can charge or about their expected growth. But that's neither here nor there. Point is, like Apollo is in the business of being an expensive asset manager. And one thing that might happen, one thing you could imagine is like if all of their pushes to be like mass market and retirement savings and all these things all come true, then like possibly there'll be some fee compression, right? Possibly you can't charge the same fees for everyone's retirement account that you can charge for like private equity.
I would imagine so. Also, John Farrell on BTV interviewed Mark Rowan the day after the Investor Day, and he asked the good question, which is that you have rates coming down, the economy is looking pretty good right now, financial conditions are easy. Why would people keep going to the private credit markets versus issuing in the public markets? Which I think is a fair question. Mark Rowan said something like, we're doing things that the public markets wouldn't allow. And then he talked about infrastructure for a while. But there was also an interesting story on the terminal from Ellen Schneider and Michael Toblin, quoting Bank of America research that said almost $30 billion of private debt has been refinanced through broadly syndicated loans across more than 70 deals so far this year. So banks reclaiming some ground there from private credit.
Yeah, that makes sense. As you said, they just did a big, partnership with Citi, right? So I think there's a real view that private credit is going to stick around. You can imagine a story of like a lot of private credit funds raised a lot of money because it's very hot. And then like in a year, they need to deploy that money and they are possibly giving better terms than the public markets, right? I think a lot of the story of private credit in recent years has been like when public markets seized up, private credit seized a lot of share. But you could imagine a story of just like there's so much money in private credit, it's going to be cheap. And watch this space. Goodbye.
Watch this space. Bye-bye.
And that was the Money Stuff Podcast. I'm Matt Levine.
And I'm Katie Greifeld.
You can find my work by subscribing to the Money Stuff newsletter on Bloomberg.com.
And you can find me on Bloomberg TV every day on Open Interest between 9 to 11 a.m. Eastern.
We'd love to hear from you. You can send an email to moneypod@bloomberg.net. Ask us a question and we might answer it on air.
You can also subscribe to our show wherever you're listening right now and leave us a review. It helps more people find the show.
The Money Stuff Podcast is produced by Anna Mazarakis and Moses Andam. And special thanks this week to Kel Brooks.
Our theme music was composed by Blake Maples.
Brendan Francis Noonan is our executive producer.
And Sage Bauman is Bloomberg's head of podcasts.
Thanks for listening to the Money Stuff Podcast. We'll be back next week with more stuff.